Most investors today do one simple thing. Every month they send money into the S&P 500, MSCI World, or Nasdaq 100. And it feels good. Diversified portfolio, hundreds of companies, nothing to think about. I mostly agree. I hold ETFs myself, though I haven't added to them in over a year. Over the last 12 years, they've returned me 11 to 12% a year, which is great. This isn't an anti-ETF video. For most people, ETFs are fine. The average investor makes about 4% a year. What actually moved the needle for me was something else: stock picking. There, I've historically managed around 25% a year. Last year alone, that was tens of millions in profit. Not a guarantee for the future, but it taught me the average investor really can be beaten, and I think the next decade will make that easier than the last one. Why? Because the S&P 500 isn't as diversified as people think. It's not 500 companies each sitting at 0.2%. It's market cap weighted. The bigger the company, the bigger the weight. Today, the top 10 companies make up roughly 40% of the whole index. 10 companies out of 500. And it's not just concentrated. It's concentrated in one place. Almost the entire Magnificent Seven is running the same story. AI chips, cloud, data centers, hundreds of billions in spending. That future earnings are supposed to justify. Maybe that plays out. I'm not calling it a bubble. The problem isn't the quality of these companies, it's the price and the concentration sitting in your portfolio. A stock doesn't need to be bad to be risky. It just needs too much optimism already priced in. A small disappointment is enough, and because these names carry so much weight, everyone holding the S&P 500 feels it. Here's something else investors underestimate. Diversification isn't just about how many ETFs you hold. It's also about not having your entire portfolio with one broker. I use several myself and recently added Freedom24, a European broker under Freedom Holding Corp, publicly traded on Nasdaq under FRHC, whose shares have grown nicely over the past 5 years. Your first deposit gets you up to 20 free shares worth up to $800 each. Links in the description. Freedom24 makes the most sense for more serious, long-term investors who want a professional setup and don't want everything in one place. Every client also gets a dedicated account manager from day one, which matters once you're investing larger amounts. Back to the point, when you buy the S&P 500 today, you're not buying a neutral basket of 500 companies. You're buying an index where 10 names are 40% of the weight. Adding Nasdaq 100 on top isn't automatically more diversification either, since it's even more concentrated in tech. You can easily hold 5 ETFs and still be massively exposed to the same handful of US tech names. That's why I think stock picking will be more interesting over the next decade. If the giants stumble even a little, the index as an average could end up returning something closer to 4.8% a year. That's exactly where the opportunity shows up for someone picking stocks systematically. Companies with strong cash flow, reasonable valuations, and a price that doesn't require 10 more years of flawless execution. Often that's quality businesses outside today's biggest narrative, names like Booking Holdings, McDonald's, or Rheinmetall. On the flip side, I've been trimming pure AI plays like AMD and Dell. Practically, look at your top 10 positions across all your ETFs combined, not each fund separately. You might own more Nvidia, Apple, or Microsoft than you think. Check your sector and geographic exposure, and make sure your portfolio actually matches your time horizon. I'm not saying sell the S&P 500 or stop investing in ETFs. The US still has some of the best companies in the world, but it doesn't make sense to build an entire portfolio on the bet that US big tech and AI deliver flawless results for another 10 years. That's why I'm also looking outside the pure US tech story, for example at KWEB, the Chinese tech ETF, which carries real risk but also has a lot of bad news already priced in. The point isn't to run from the US, it's to not bet your whole net worth on one region or one story. The S&P 500 isn't bad. ETFs aren't bad. What's bad is blindly believing one index will solve everything. Because when you don't know what you own, you don't have a strategy, you just have faith the market average will save you. And faith is fine in church. Investing needs a system. Link to Freedom24 and its bonus offer is in the description. Thanks for watching. Take care.